Hi, this is Nick here, and I'm about to go through the updated chart book on the U.S. business cycle. So here we have the leading economic indicators index year-over-year rate of change, which has ticked lower from last month's report from plus 6.1% year-over-year to plus 5.8%. So it does seem like we have a deceleration in terms of the year-over-year rate of change in the leading economic indicators index from the Conference Board. The index itself is continuing to make new cycle highs, but with a slowing rate of acceleration. So this is something to watch going forward and makes me less positive on this picture than in previous months. Then on the U.S. yield curve steepness, so this has ticked a little bit higher since last month's report from 19 basis points to 21 basis points on the 3s-10s curve. So that's the 10-year yield minus the 3-year yield. This could go inverted before the end of this year. Just going to continue to monitor this. The flattening trend certainly seems to generally be continuing. Has been pretty steady over the past few years. In terms of PMIs, manufacturing PMI ticked lower from 60.2 to 58.1, but still at the higher end of the multi-decade range there. What would get me negative is seeing the PMIs, the manufacturing PMI, which is the black line, go below the 50 level. Then in terms of global manufacturing PMIs, so it continues to be a little bit of a mixed picture here in terms of the developments over the past month, but all but one of them are still above 50. Last month, actually, two were below 50, Brazil and Russia. Now just Russia is below 50. So continuing to monitor this, we do see some the appearance of some deceleration in terms of global growth. And framework on this is to watch out in particular for the largest economies in the world, so China, India, Germany, or Japan. If those were to fall below 50, that would be a warning sign. Then in terms of the U.S. unemployment rates, we got the jobs report last week, and the U3 unemployment rate ticked down from 4.0 to 3.9. So that's still above the cycle lows, which were 3.8. The cycle low is 3.8% from a couple of months ago. But you can see here still the U3 is below its 12-month moving average, which is the gray line there. And the framework for this chart is to look for a negative signal from the crossover of the U3 through its 12-month moving average, which we have not yet seen. Then this is this replica of the San Francisco Fed unemployment rate model. It's meant to be a leading indicator for what's going to happen with the unemployment rate. That data series continues to look generally positive, suggesting that the U3 rate should continue to trend lower. What would get me negative is to see this gray line, which is the model, bottom and start to trend higher. Then in terms of the labor market capacity utilization, so pretty much no update on the interpretation of this picture. It does seem like the U.S. economy is potentially operating above capacity in terms of labor resources, given how low the unemployment rate is at 3.9%. In terms of the output gap, which measures the current output relative to the potential output, which is estimated by the Congressional Budget Office, this series, which is from Bloomberg, does not yet show that output gap as being completely closed, but very well may once we get the updated data point for it. Then the Atlanta Fed GDP Now forecast for Q3 looks pretty strong at 4.4%. This is a very noisy, very volatile data series, but it was a pretty good indicator of where the Q2 number would come in, which was, you can see the official number for Q2, which just came out. That came out at 4.1%. That's the first reading for the Q2 GDP growth rate. That will get updated two more times. It may or may not change. The 4.1 might change a little bit. So we'll continue to monitor that, but Q3 also looks like it could be a strong quarter, according to the Atlanta Fed GDP Now forecast. Then U.S. household credit cycle, so this measures the percent of household debt that's delinquent, so lower is better here, and this is only a quarterly series. for the cycle, the percent of household debt that's delinquent has continued to make new lows, which is a positive sign for the economy. We will get an updated data point on this later this month, so next month's report will reflect the update. And what I'm looking for here is the crossover between the 3-quarter moving average, which is the black line, and the 6-quarter moving average, which is the gray line. Then in terms of consumer confidence, these generally can continue to trend higher, which is a near-term positive. You could argue that these are at somewhat elevated levels historically, and that can be medium-term a negative contrarian signal. Then in terms of the bank lending standards, this is a quarterly data series, and I don't think we have an update on this from last month's report, but what is shown here is that bank lending standards continue to be supportive of the economy. In terms of the high yield spread, so this takes the high yield bonds or junk bond spreads over treasuries, and that has remained contained over the past couple of years. You can see that's at 3.32%, and that's come down a bit since last month's report, which is generally a neutral to positive sign for the economy. Then the overall checklist here, so the overall interpretation, taking everything together, most of these line items continue to have positive characterizations. Overall, the short-term outlook, which I'm defining as within the next 6 months, is still positive, with a neutral and more uncertain outlook over the medium to longer term.